Jason here with SwingHigh.com. It is Friday, January 15th, 2009, and this is your post-market analysis. Today was options expiration day. We definitely had a sell-off. There's no denying that. The S&P down over 1%, the Dow almost a full percent, the Nasdaq down just over a full percent, the Russell's down 1.2%, and the financials down a full 2%. So the Nasdaq, Russells, and financials were the weakest today, which is not a good thing to see for the bulls. Volume was also strong today. I'll show you that as we zoom out here, but we'll take a quick look at the market internals. The trend, definitely bearish. Over 1.2 is bearish. This was hovering around 2 most of the day, so much more volume flowing into stocks on the decline than on the rise. The trend Q tells a similar story here, over 1.2, definitely bearish. The tick was predominantly bearish, started to drift into more bullish territory at the end of the day, and the tick Q stayed bearish all day. That's incredibly bearish on the tick Q. The VIX. The VIX was confirming the move downward nicely, and until the very end of the session when it just gave it all up. Right around 3:45 Eastern Standard Time, the VIX was at up about 3%, which confirms a 1% move down in the markets, but the VIX actually closed down or up only 1.5%, which kind of takes a little bit of that confirmation away from the VIX's move here. So here we are again looking at SPY, the S&P 500 tracking ETF. As you can see, this morning we gapped down, did not fill the gap, just sold off straight down. Hung up here at this support area at 113.70, and then sort of made a triangle type formation, kind of a weak one, and then just continued to sell off into the middle of the session when we found support down here at 113 area. After finding support there, we turned around, made a nice reversal pattern there, and found resistance again at the 113.70 area. So it's good to see the markets reacting to some of the support and resistance lines pretty well. This one back here at 114.30 was just shattered. Pretty much no hesitation there. So things look bad. As if you see this slanted line here, this thick line, we did break below that and closed below it. On the daily, that was this long trend line that we have from March of 09. And I was talking about how the S&P was struggling to get off of this support line. And yes, today we broke down through it on strong volume, but I am not ready to go bearish here. I still cannot count the bulls out, even though we're down pretty big today. We could get a day much like this one where we broke down through the line and then gapped up right above it again. So that's what I'm seeing, and we are still sort of holding up in a high base type formation. As you can see, back in November we had this, and into December we had this choppy high base formation going, and then we did break out early in January here. Now we had a slight run up and we're making another high base type formation. And one thing I do like to see is the fact that we have this longer shadow here on the bottom of today's candle, and we bounced off of the bottom of the high base formation quite nicely. So as long as we hold up in that high base, I am still going to be bullish here, and we'll just have to see what happens next week. Real quickly, I'm going to go to the monthly chart of the SPX, which is the S&P index. And if you remember back in November, I drew in this Fibonacci retracement and a couple trend lines, and things are looking bullish based on those drawings. We are above the 50% retracement on the Fibonacci, and we broke above these trend lines, so that is good to see for the bulls as well on a longer term time frame. Thanks for being a part of SwingHigh.com. I'll talk to you later.